Welcome, everybody. Thank you for joining us in this public briefing on NAFA's recommendations regarding appraisal bias risk management. I'm Maureen Yap, Senior Counsel at the National Fair Housing Alliance. I'll be joined today by my colleagues, Morgan Williams, NAFA's General Counsel, Scott Chang, Senior Civil Rights Counsel, Siobhan Ferguson, Senior Associate Director of Enforcement, and Aaron Kempel, Vice President of Fair Housing Services. To start us off, we will hear opening remarks from NAFA's President and CEO, Lisa Rice. Lisa, next slide, please.
Hello, everyone. Thank you, Maureen. Thank you, everyone, for joining us here today. The National Fair Housing Alliance represents roughly 200 fair housing groups and other justice-based organizations throughout the United States. And our goal is to eliminate all forms of housing discrimination and ensure equitable housing opportunities for all people and communities. You know, for most Americans, the home is their single most important asset and holds the key to wealth, stability, and opportunity for their families. But America's long history of discriminatory housing policies has undervalued homes for people of color, perpetuated inconsistent outcomes, and entrenched an unfounded association between race and risk. Today, the Black-white homeownership gap is larger than it was when the Fair Housing Act was passed in 1968. And the wealth gap between white households and households of color remains large and persistent. The Fair Housing Act's promise of fair and equitable housing is unfulfilled. We have all heard the shocking stories of appraisal bias from across the country, including stories of whitewashing, where homeowners of color have had to go through the excruciating experience of removing all evidence of their racial and national origin identity just to receive a fair appraisal. From Carlette Duffy in Indiana, who received an increase of almost $150,000 after asking a white friend to pose as her brother, to the Tate Austin family in California, who received an increase of almost $500,000 after asking a white friend to pose as the homeowner. These disturbing and even heartbreaking stories have shone a light on the serious shortcomings of the current appraisal process. Additionally, government, private sector, and academic researchers have shown disparate appraisal outcomes for consumers in communities of color on a systemic basis. As a result of these individual and systemic findings, many advocates, appraisal and lending industry stakeholders, and government entities have answered the call to find solutions to this challenge. For example, in 2022, NAFA, along with the Dane Law and Christensen Law Firm, issued a groundbreaking study to identify opportunities for improvement in the uniform standards of professional appraisal practice and the real property appraiser qualification criteria. We also had the honor of briefing the President's Interagency Task Force on property appraisal and valuation equity. Finally, we have worked with numerous advocates and industry allies to propose improvements to legislation, regulations, processes, and standards to ensure fair and accurate appraisals for all consumers and communities. We believe we can build on the long history of using fair lending risk factors to identify potential discrimination, as well as best practices in fair lending compliance management systems to prevent violations and harm in the appraisal sector. We hope that the recommendations we offer during today's training provide an insightful and useful framework and provoke a thoughtful conversation about a path forward that benefits the whole of the housing market. Thank you for your dedication to promoting fair housing for all, And with that, I will turn it back over to Maureen.
Thank you, Lisa. Next slide, please. Now let's turn to the agenda for today's briefing. We'll cover the following topics: a little bit of background on the framework we're using for the recommendations. Then we'll turn to each of the risk factors: higher valuations, appraisal reports, business processes, compliance management systems, and finally, statistical analysis. Next slide, please. Next slide, please. So why are we sharing these recommendations today? Well, we believe that these risk management recommendations can reduce risk for all stakeholders in the housing market. First, the recommendations can reduce the risk of harm to consumers and communities from inconsistent outcomes on the basis of race or other prohibited basis. Fair and consistent appraisals can help build equity for individual homeowners and value for communities, and they can help bridge the racial homeownership and wealth gaps. Second, fair and consistent appraisals can help lenders, AMCs, and appraisers minimize legal risk, build trust in the industry, ensure the safety and soundness of the housing system, and build businesses that can serve the whole of the community. And finally, fair and consistent appraisals can help the American economy overall. Researchers estimate that racialized appraisal practices result in $15 trillion more for white communities. So improving appraisal practices would generate more equity for consumers and communities of color, improve purchasing power, and grow the economy. Next slide, please. So what risk are we focused on here? These recommendations focus on the risk of violating the fair housing and fair lending laws that prohibit appraisal discrimination. Those laws are the Fair Housing Act, the Equal Credit Opportunity Act, and the Civil Rights Act of 1866. To clarify, under the Uniform Standards of Professional Appraisal Practice, or USPAP, there is a broader concept of bias, which is defined as a preference or inclination that precludes an appraiser's impartiality, independence, or objectivity in an assignment. That definition is very broad and beyond the scope of today's discussion. Here, we are focused on preventing bias and violations on the statutory prohibited bases of race, color, national origin, religion, age, disability, familial status, marital status, source of income, and sex, which includes sexual orientation and gender identity. Next slide, please. So what framework are we using? These recommendations contain risk factors based on current federal cases, HUD complaints, GSE quality control findings, news articles, and research. Federal regulators have long used fair lending risk factors to indicate the risk of a violation of fair lending laws. Risk factors generally are fact patterns that are commonly found in certain types of discrimination. For example, a lack of bank branches in communities of color is commonly regarded as a factor indicating the risk of redlining discrimination. These recommendations also contain risk management techniques based on supervisory guidance and best practices. Federal regulators have long advised institutions to develop appropriate compliance management systems to minimize the risk of fair lending discrimination. And just recently, the federal financial regulators released information entitled Statement on Examination Principles Related to Valuation Discrimination and Bias in Residential Lending. This statement confirms that regulators view standard risk management techniques as appropriate to control the risk of appraisal discrimination. Next slide, please. So what specifically will be covered for these risk factors? Well, for each risk factor, we will cover an overview of the risk factor to ensure we all understand what the risk factor is, and the common standards for the risk factor, such as the GSE standards. This is important because a key indicator of discrimination is a deviation from standard practices. That is, the risk of discrimination increases if the consumer is being treated differently than another consumer normally would be treated using standard practices. For this reason, we have included cites to the common standards so industry and advocates could research them to see if consumers are being treated differently. Next, we include examples of the risk factors from the federal cases, HUD complaints, GSE experiences, and research. We have heard from some that case studies are not available. But in fair lending, the cases are usually fact patterns that can lead to a complaint and settlement. Over the history of fair lending since the 1990s, these cases have rarely been fully litigated. For that reason, it's important to look beyond fully litigated cases for insightful fact patterns. Finally, we offer recommendations for risk management techniques with two important caveats. First, we understand that many appraisal firms are just one or two person shops. So here we are offering general risk management techniques, but each firm needs to tailor its techniques to what works for them based on the size and risk profile. Second, we frame the recommendations as suggestions for appraisers, but others may find this framework useful as well. For example, lenders and AMCs can implement these recommendations to minimize risk and conduct robust third-party oversight. Similarly, government investigators and advocates can look for these risk factors and risk management techniques to determine whether there is a high risk of a potential violation of law. Next slide, please. So who are these recommendations for? Well, these recommendations can empower many key stakeholders, including appraisers, AMCs, lenders, GSEs, government investigators, government examiners, state licensing boards, fair housing groups, consumers, and researchers. The recommendations can empower all of us to identify appraisal bias risk, take action, and help close the racial homeownership and wealth gaps. So let's get started. Next slide, please. And now I'll turn it over to Morgan. Morgan?
Thank you, Maureen, and thank you all for joining us today in this presentation about recommendations for appraisal bias risk management. Many allegations of discrimination start when the consumer discovers a valuation that's significantly higher than the one received from the first appraisal. Next slide, please. The higher valuation may raise concerns that the first appraisal has unexplained errors or departures from standard practice, which may be evidence of discrimination. Consumers may learn of higher valuations from various sources. As noted, it may be from a subsequent appraisal, or a loan officer or real estate professional may provide an estimate based on familiarity with their regional market. Tax assessments may be a gauge. Generally, tax assessments are well below the market value of a home. So if your appraisal comes in below your assessment, it could be a red flag. Or consumers may learn of higher valuations from other sources, like online sites such as Zillow or Redfin, or in the case of home purchases, the contract value itself. A higher valuation does not automatically mean that the first appraisal is affected by discrimination, but the existence of a higher valuation may be enough for a consumer's claim of discrimination to go forward in the legal process. Next slide, please. There are at least two ways to manage the risk of discrimination related to higher valuations. First, you can quickly review public sources, such as online estimates and the other noted sources. Of course, these valuations are not as nuanced or precise as an appraisal, but they can serve as a quick check. In any event, the consumer also has access to these sources and may raise questions about the appraisal based on them. In the case of a home purchase, the contract price, again, may be informative. Given the research showing that appraisals are more likely to come in under the contract price in communities of color, it's important to review the appraisal carefully for errors or departures from standard practice if it looks like the appraised value will be under the contract price. Second, to mitigate fair housing liability risk, you can conduct error reviews. An error review is especially important if other sources indicate a higher value. You may even want to use a checklist of common errors to quickly review the appraisal report before it's finalized. If you're a lender, AMC, or sophisticated appraiser, you may want to institute a compliance system that checks for higher valuations and possible errors. Next slide, please. Most allegations of discrimination show not only a higher valuation in the second appraisal, but also irregularities in the first appraisal. Next slide, please. In fact, the appraisal report can be the most critical indicator of whether discrimination occurred. We'll address them in turn in this presentation. We identify 5 risk factors in the appraisal report that we group in categories: overt statements, subject property, comparable sales, value adjustment, and reconciliation. Notably, most of the risk factors that show up in allegations of discrimination are the same areas that Fannie Mae and Freddie Mac review for quality control purposes. As such, as Maureen noted, by mitigating fair housing risks in the way that we'll discuss, you're improving the quality of the appraisal. The sales comparison approach detailed on this slide is a valuation policy that's typically used by Fannie Mae, Freddie Mac, and others in the industry. The sales comparison approach contains several risk factors that can increase the risk of discrimination. In particular, the risk factor of broad discretion has long been considered to add to the risk of discrimination and may constitute a policy that has a discriminatory impact. Similarly, the lack of compliance controls on accuracy for the subject property is also a risk factor. Even though the sales comparison approach does not use an explicitly race-based method, research has shown that it has different and adverse outcomes for communities and consumers of color. And as we will unpack, its application may constitute a basis for liability. Next slide, please. Let's start with the first appraisal report risk factor, overt statements. A core tenet of fair housing law is that one way to show disparate treatment discrimination is through direct evidence, which can include express discriminatory statements, also known in the cases as overt statements. For example, a bank regulator determined that a bank violated the Fair Housing Act when it expressly required appraisers to value mobile homes in adult parks higher than those in family parks. This overt policy statement was evidence of discrimination on the basis of familial status, one of the 7 federally protected classes under the Fair Housing Act. A recent study by the Federal Finance Housing Agency showed that thousands of appraisal reports contain language that seems to show a preference on a prohibited basis, such as race, national origin, or religion. For example, one report called out the presence of storefronts supplying Jewish households, a fact that would be unrelated to the value of the home and may constitute a strong indicator of discrimination. The problematic statements can occur in any area of the appraisal report that allows for discretion when populating text in the report. Next slide, please. Fannie and Freddie have provided guidance on unacceptable appraisal practices, including words or phrases that may signal the risk of discrimination. To promote equitable processes, the GSEs have implemented text scanning to detect words or phrases that may indicate discrimination. Appraisals that contain these words or phrases can result in warnings, declined appraisals, or referrals to state regulators for possible sanctions. Next slide, please. Generally, the problematic words or phrases fall into 2 categories: potentially discriminatory words or phrases and subjective words or phrases. This could include developing a valuation conclusion based either partially or completely on the sex, race, color, religion, disability, national origin, or familial status of either the prospective owner or occupants of the subject property or the present owner or occupants of the properties in the vicinity of the subject property. This could also include the use of unsupported or subjective terms to assess things like high, low, good, bad, fair, poor, strong, weak, rapid, slow, fast, or average, without providing a foundation for analysis and contextual information. Next slide, please. This is the less than complicated part of the presentation. To avoid the risk of discrimination related to overt statements, don't use them. That is, don't include words or phrases that reference a protected class in the report. Additionally, focus on the objective data and analysis. Vague and subjective words or phrases are ultimately not helpful in showing support for the opinion of the value, and they elevate the risk of discrimination. Next slide, please. Now, let's turn to the second appraisal report risk factor, the description of the subject property. Many allegations of discrimination include incorrect descriptions of the subject property. Descriptions related to the subject property can be found throughout the appraisal report, but the most important description is found on page 2 of the Uniform Residential Appraisal Report, where the report indicates which features of the home were included as elements of comparison when considered in the context of comparable sales. Again, Fannie and Freddie have provided guidance on unacceptable appraisal practices related to the subject property description. In addition to noting the nature of unacceptable appraisal practices, the GSE guidance states that the lender must ensure that the appraiser described the property in factual, unbiased, and specific terms. Next slide, please. The types of incorrect subject property descriptions that can increase risk fall into 2 categories: those based on accuracy and those based on discretion. Accuracy refers to the elements of the subject property that generally only have one right answer, such as the number of rooms above grade. Elements of the subject property that are commonly subject to accuracy errors and allegations of discrimination include actual age, room count, and gross living area. Discretion refers to elements of the subject property that generally are more subjective and rely on judgment, such as which improvements are important in the market. Elements of the subject property that are commonly subject to errors of discretion in allegations of discrimination include quality of construction ratings, condition ratings, and improvements. Next slide, please. Fannie and Freddie provide guidance on the discretionary elements of the subject property description, including quality control ratings and improvements, as the appraisal report must rate the property on a scale for quality of construction and for condition. On the slide here, Collateral Underwriter, which is Fannie Mae's proprietary collateral risk management tool, detected an incorrect condition rating for the subject property, which led to the appraisal report using inappropriate value adjustments for the comps. This incorrect condition rating increased the risk of undervaluation for the subject property. Depending upon the context, this may support a claim of discrimination. Next slide, please. To manage the risk of discrimination related to incorrect subject property descriptions, review public sources such as tax assessments, MLS listings, and online estimates. Conduct error reviews to look for inconsistencies. Develop checklists of common improvements or common property elements that result in certain quality or condition ratings. And ensure consistent treatment across all neighborhoods. You can pull a random sample of appraisal reports to audit them for any unexplained differences and revise the checklist accordingly. Now, let's turn to the third appraisal report risk factor, and I'll hand it over to my colleague, Scott Chang, to discuss how comparable sales may be analyzed in the appraisal report.
Thanks so much, Morgan. Next slide, please. As Morgan said, the sales comparison approach compares the subject property to other comparable properties in the area to determine the appraised value. The selection of comparable sales is the most significant risk factor because it allows for broad discretion and is at the center of the sales comparison approach. Broad discretion is a key fair housing for lending risk factor as it allows for explicit or implicit bias to affect decisions. This is a graphic of the Uniform Residential Appraisal Report showing the elements of this selection of the comparable sales that are commonly subject to error: neighborhood and proximity to subject, condition of sale, and date of sale, and elements of comparison. Next, let's discuss industry standards regarding the sales comparison approach. Next slide, please. Both Fannie Mae and Freddie Mac have provided guidance on the unacceptable appraisal practices, including practices related to the selection of comparable sales. The Fannie Mae guide states that unacceptable appraisal practices include misrepresentation of the physical characteristics of comparable sales, selection and use of inappropriate comparable sales, failure to use comparable sales that are most locationally and physically similar to the subject property. The Freddie Mac guide states that unacceptable appraisal practices include inclusion of inaccurate or incomplete data about neighborhoods or any comparable sale used in the appraisal analysis, and reliance in the appraisal analysis on comparable sales that were not personally inspected and which requires at least a visual inspection by the appraiser of the exterior of the comparable property. Next, let's discuss examples from appraisal discrimination cases. Next slide. Case examples show how discretion in selecting the neighborhood and proximity to the subject can increase risk. The allegations in a Maryland case provide an example of the concerns regarding how to define the neighborhood and proximity to subject property for purposes of choosing comps. In this case, a Black couple received an initial appraisal of $472,000, and then after whitewashing the home, received a second appraisal of $750,000. The complaint alleged irregularities in the selection of comparable sales in the first appraisal, among other things. The map depicted on this slide shows that the first appraisal selected two comps labeled L2 and L4 that were in majority Black census tracts, one of which was outside the neighborhood. By contrast, the second appraisal was able to find comps labeled as D1 and D5 that were all within the neighborhood and not directed to majority Black census tracts. Thus, the first appraisal raised concerns that comps were selected based on the race of the homeowners, rather than based on comps that were the most locationally and physically similar to the subject property. Next, we will discuss discretion in selecting comparable properties based on the condition of sale and time of sale. Next slide, please. Discretion in selecting comparable properties based on the condition of sale and time of sale can also increase risk. Another common allegation in cases asserting discrimination in appraisals is that the selected comps did not follow the industry standards for condition of sale or time of sale. In these cases, homeowners of color alleged that more appropriate comps were available, but the appraisal report instead used comps that were old or were not arm's length transactions. For time of sale, Freddie Mac and Fannie Mae guides state the appraisal report should generally use comparable sales that have been closed within the last 12 months. On condition of sale, generally the appraisal report should use arm's length transactions. However, the appraiser has discretion to use other types of transactions, such as foreclosure sales and short sales. In those cases, there should be an appropriate value adjustment to reflect the atypical condition of the sale. Now let's turn to the third area of discretion in comparable sales that can increase risks: discretion in using comps based on the elements of comparison. Next slide, please. Discretion in selecting comparable sales based on elements of comparison can also increase risk. Another common allegation in cases asserting discrimination is that selected comps were not similar to the physical characteristics of the subject property. In these cases, homeowners of color allege that more appropriate comps were available, but the appraiser used their discretion to instead use comps that were dissimilar and inferior to the subject property. The Fannie Mae guide provides that comparable sales should have similar physical and legal characteristics when compared to the subject property. These characteristics include, but are not limited to, site, room count, gross living area, style, and condition. In the example shown on this slide, one of the comps appeared to be significantly different and inferior to the subject property, which increased the risk of under-evaluation. Now let's consider how to decrease the risk. Next slide, please. Risk can be decreased by documenting decisions. There are a few ways to manage or avoid the risk of discrimination related to the broad discretion found in comparable sales. First, develop checklists. Appraiser can develop checklists, policies, and procedures to provide more consistency in common issue areas, including neighborhood and proximity, condition of sale, time of sale, and elements of comparison. Second, document decisions. An appraiser can document why certain selections were made, particularly if they relate to the common issue areas. Documentation is particularly important where there is departure from standard practice, which is one way of showing discrimination. Third, conduct audits. To ensure consistent treatment across all consumers and communities, the appraiser can pull a random sample of appraisal reports to audit them for any unexplained differences. Among other things, the appraiser can plot the comps on maps that show the race or ethnicity of census tracts to look for any patterns that appear to be based on the race or ethnicity of the borrower or neighborhood. Now let's turn to the fourth appraisal risk factor, value adjustments. Next slide, please. Value adjustments may show the risk of discrimination. Under the sales comparison approach, the appraisal report should show value adjustments for each subject property element that is different from the comp and that the market or typical buyer would consider important to the value of the home. Value adjustments are an appraisal report risk factor because they allow for broad discretion. The risk here, however, may be difficult to mitigate because there are no hard and fast rules as to what an appropriate adjustment for each key element of the subject property. The example shown on this slide shows some typical value adjustments in absolute dollars. Generally, errors in value adjustments fall into two categories: inaccuracies in math and discretion. Next, let's discuss some industry standards. Next slide, please. Fannie Mae and Freddie Mac have provided guidance related to value adjustments. Fannie Mae prohibits the use of adjustments to comparable sales that do not reflect market reaction to the differences between the subject property and comparable sales, not supporting adjustments in the sales comparison approach, and failure to make adjustments when they are clearly indicated. Freddie Mac prohibits use of inordinate adjustments for differences between the subject property and comparable sales that do not reflect market reactions to such differences, and the failure to make proper adjustments when they are clearly necessary. Now let's turn to some examples from the cases. Next slide, please. For an example of elements of comparison, an appraiser for a Black couple in a predominantly white suburb in Maryland made downward adjustments to the sales price of comps and failed to make appropriate upward adjustments to reflect features that were in the subject property. A second appraisal provided smaller downward adjustments and up to double the amount of upward adjustments. For quality ratings, an appraisal for a mixed couple living in a predominantly white suburb in Connecticut applied value adjustments inconsistently. 3 of the comps were assigned a Q2 rating and had value adjustments of 10%. By contrast, another Q2 comp had a value adjustment of 20%. For neighborhoods, an appraiser for a Black couple living in a majority Black census tract in a predominantly white county in California selected 3 comps from outside of the majority Black census tract. When evaluating these comps, the appraisal made downward adjustments of 25%. Historical data plus an unexplained additional reduction. Now let's consider how to decrease risk. Next slide, please. Like risk management for comparable sales, there are a few ways to manage or avoid the risk of bias and discrimination related to the broad discretion found in value adjustments. First, conducting error reviews. The appraiser can check for value adjustment errors, such as subtracting an amount that should instead be added, calculating the price per square foot, and adding the total value adjustments to the original sales price. Second, developing checklists, documenting decisions, and conducting audits. The appraiser can develop checklists, policies, and procedures to provide more consistency. The appraiser can document why certain selections were made, particularly when there's departure from standard practice. And finally, to ensure consistent treatment across all consumers and communities, the appraiser can pull a random sample of appraisal reports and audit them for any explained differences. Now let's turn to the final appraisal risk factor, reconciliation. Next slide, please. Reconciliation may show the risk of bias. The appraiser must reconcile the adjusted comp value to determine the final opinion of value, which should not be based on an average, but rather the relative relevance of each comparable. The final reconciliation is appraisal risk factor because it allows for broad discretion. The risk here, however, may be more difficult to mitigate because there are no hard and fast rules as to how to reconcile the findings from the sales comparison approach. Fannie Mae and Freddie Mac have provided guidance that prohibits reporting an opinion of market value that is not supported by market data or is misleading. While there are no cases directly on point, the guidance suggests the following risk: whether there is sufficient number of comps to develop an opinion of value, which comps should be given the most weight, and how to document the reasoning for the final opinion of value. And finally, risk mitigation. The risk can be mitigated by conducting error reviews, developing checklists, documenting decisions, and conducting audits. Now I will turn it over to my colleague, Siobhan Ferguson.
Thanks, Scott. Next slide, please. So in my section, I'm going to talk about the risk of discrimination that can occur throughout your business processes. And by the end of the section, you're going to know what those risks potentially are, and also some effective methods to reduce that risk. Next slide. There are two main categories of risk that we want you to think about. The first being consumer interaction, which I'll go over now. The second being the request for reconsideration of value process. The consumer interaction process essentially is how and when you engage with the consumer directly, or about the consumer interaction about the appraisal. Any communications with the lender could also come into play when we think about that here. I'm going to talk about two examples from other housing markets, and then kind of tie it all together so you understand how this affects and can play a role in the appraisal process. So when we think about risk of discrimination, generally in the fair housing context, we're thinking about how you treat someone based off of how you treat someone in comparison to somebody else, and is there a connection between their protected class status. So Newsday did a study about 3 years in 2020, which was a 3-year study of 93 real estate agents in Long Island, New Jersey. And what they had found was that over that period of time, when they were looking at two consumers, or they sent out two consumers, one African-American and one white consumer, similarly situated, they can afford the same thing, they have a similar financial profile, and they engage with the same agent. Over that period of time, what they found is that African Americans, or the Black consumers, were 49% more likely to experience discrimination than their white counterparts, and specifically experience disparate treatment from the real estate agent. What does that mean? Well, that means that some examples they gave was the Black consumers were not receiving any sort of service from the real estate agents, where their white counterpart did receive service, or they were given less options to see homes. They were given higher hurdles in order to gain access to even just tour a home, or they were shown other homes or properties that their white counterparts were not shown. And so it's over that period of time, when you think about the difference of treatment, then we can indicate that that's probably discrimination. In the insurance market, and similarly in 2023, there was a case, Husky v. State Farm Fire, for those who are familiar, that alleged discrimination in the consumer interaction with respect to homeowners insurance. Although the case was focused on discrimination of the algorithm used by the insurance company, the case is still a useful example of risk in the business process. In this case, the plaintiffs alleged a large, statistically significant disparity between Black and white homeowners in the processing times for homeowners insurance, paperwork required to process the claims, and the number of interactions between the insurance company and homeowners. I think those 2 points are important for you to think about as an appraiser, because when we think about how a consumer is treated, we can definitely directly ask the consumer about their experience and why they believe discrimination occurred. There might be an explicit statement that they're concerned about, or they're just unsure if they experience the same amount of treatment as maybe their counterpart. Or we can also think about your pattern or your history of behavior with consumers and see if there's a pattern of, an appraiser treating someone differently based off of a protected class status like race. Next slide. The importance of that consumer action for, when we're assessing risk for discrimination can range. It could be something that just draws an interest of, is there something else going on here? Do we need to dig deeper? It could be a brick in a wall of evidence, or it could be the evidence. It really just depends on the severity of that interaction and also the, how prolific that experience is across a appraiser's history. And so I don't want you to think that you can't have a bad day or you can't have anything, like any experience that happens to be different than another day. What I want you to be mindful of is if there's a difference in how you're treating somebody and we recognize that there's a pattern, that could be, something to be concerned about and something we want to look for as to why that is happening. Next slide. You can manage that risk by creating and following consistent processes. The appraiser can develop and follow consistent processes for consumer interactions, including responses to how you're interacting with the consumer and information request, and appraisal report processing time. So in the slide prior, when what you might have seen was one of the appraisers had responded 75 days later to a consumer request for the appraisal report, where the response time for their counterpart was significantly less. If there's a consistent process and we follow it in terms of when you're giving people appraisal reports, that's a good example of how you can manage that risk or concern around discrimination. And then avoiding assumptions. The appraiser should avoid assumptions or treating people differently because of their race, and also, avoid inappropriate comments during the property or visit of other interactions. We have examples of explicit derogatory comments, but they're also just, interactions that the consumer can consider as off or not sure of why they did that, and that itself can be an indication to kind of raise a flag or raise concerns. For example, one of our complainants, or someone I spoke with, talked about an appraiser coming into their home and, making sort of suggestions that something that they owned was fake and checking to see if it was real. And every time they went throughout their home, they would check this piece of art and indicate, or determine or test whether or not it's real. It's not really your role as an appraiser to kind of be doing that. It was a concern from them. Maybe that appraiser does that all the time. Regardless, it sprouts some red flags for the consumer. And so, escalated a situation simply because, the appraiser was acting inappropriately. So just be mindful of how you engage in someone else's home. Next slide. All right, so the reconsideration of value process. As you know, there are several ways for a consumer to bring attention to our concern if they believe that the valuation or opinion value is incorrect. One of that ways is the reconsideration of value process, where they ask the lender to ask the appraiser to reconsider the opinion given. But they can also request for a second appraisal and have another appraiser, ask the lender to have another appraiser evaluate their home. And usually that happens when the trust is maybe broken already between the consumer and the appraiser, or they believe that bias is already occurring. And then another possible way is for them to file a complaint. And that may happen when it's too late, or it's not, they don't have enough time to go through the reconsideration process or an appraisal process due to the transaction, or they believe that there is significant concern around potential discrimination in their experience with the appraiser. What I wanted to bring attention to, though, is that just remember that, or if you do not know already, there's some guidance already from the CFPB and DOJ that the appraiser independence rule is not is not a defense when there's an allegation of discrimination, and does not trump any sort of anti-discrimination laws. So just be mindful of that. And if you don't know that rule yet, please definitely take a look. Next slide. So the regulators and HUD and Fannie Mae have given some guidance on what, and drafted some guidance on how to address the ROV process. And while they're not finalized yet, we do think that you should go back and look at that guidance, because you should know what may come for you, what to expect, and also, consider those as best practices as you're developing, processes and procedures for your ROV process. Next slide. One example I wanted to highlight, because I don't want to spend too much time on the case examples, I think there's some really great case examples, is the case example from JP Morgan Bank. I believe it provides a useful example of how the ROV process can bring up some concerns, and we will assume the allegations are going to just be true for this current moment. I think it's still being worked on. But in 2028, there was a conciliation agreement with JP Morgan Chase Bank. And in that matter, a Black homeowner living in a majority Black neighborhood in Chicago, Illinois, submitted an application for a refinancing, which the bank denied due to low value in the appraisal report. Because the homeowner believed that the appraisal contained errors, they asked the bank for an ROV, or a second appraisal, but the bank denied both. Later, the homeowner applied for a refinancing with another lender who approved the application based on a new appraisal with significantly higher value. The homeowner later submitted a complaint to HUD alleging a violation of the Fair Housing Act. And so while a lot of the guidance is directed at the lender, it's still important for you as an appraiser to be mindful of how your processes and procedures can come and play a role in the ROV process, and that how you react and respond during the ROV process matters, because that's what's maybe pointed to as well when we're thinking about risk of discrimination, or thinking about how effective you were or how responsive you were to any sort of request from the lender. Next slide. So how can you decrease risk? Well, carefully evaluate the ROV request. We know that it's not a fun process. We know that it can feel, it's natural to feel discouraged by that process. But we want you to take your time and carefully evaluate the process and review the appraisal report for any errors. Any time you spend on that process really can save some time and some money in the back end in the event things are escalated down the road. And then document your reasoning. If you revise or maintain your opinion of value, make sure that's documented, and use language that others who are not familiar with the appraisal process, who may be reviewing your ROV claim as part of the discrimination complaint, will understand pretty easily why you came to your opinion and why you chose to maintain or revise that opinion of value. And I'm now going to turn it over to Erin Kemple.
You're on mute, Aaron.
Aaron, you're on mute.
I apologize. I've only been doing this for a long time, so I can understand why I'm having difficulty. Thank you. If we can go on to the next slide, I would really appreciate it. And I will also restart my video. So I want to talk about compliance management systems. Most of the time we associate compliance management systems with big banks or large institutions. And so one of the questions that a lot of appraisers ask is, why should I care about a lender's compliance management system? Or why should I try as an individual to implement a compliance management system? There are really two answers to this question. First, while compliance management system, or CMS, assists lenders in minimizing the risk of discretion, an appraiser or an AMC can also use a compliance system to minimize risk. Although the compliance system is typically considered a way to decrease risk, a weak CMS or compliance system can also be considered an indicator of increased fair lending risk. That is, if the financial institution did not carefully evaluate the fair lending risk and implement an appropriate compliance system to control the risk, then there is an increased risk of a violation of the fair lending laws. The same can be said for a compliance system used by an appraiser or AMC. While you may be an appraiser working alone or with only one other person, making the procedures that you're going to hear about in the next few minutes difficult to implement, understanding the risk that a lender is facing will help you serve your lender clients and consumers. The second reason to care about a lender's compliance management system is that the federal financial regulators have made clear in guidance regarding third-party oversight that a lender cannot outsource risk. That means a lender cannot try to insulate themselves from liability by outsourcing a task and claiming that they do not have responsibility for the execution of that task. So a lender remains responsible for its own compliance system, as well as the compliance system of its third-party vendors, such as an appraiser. For these reasons, it's important that you understand the compliance system, the principles of an effective compliance system in order to better serve your lender clients and consumers. I'm going to talk about compliance systems in board and senior management oversight, the policies and procedures that can be included, a suggestion about some training programs, how to handle consumer complaints, as well as audits and monitoring to minimize risk. Next slide, please. With regard to board and senior management oversight, federal regulators look at whether the board, management, or senior leadership provides satisfactory oversight of the compliance system. For example, does the board and management show a commitment to preventing appraisal discrimination, as evidenced by whether there are sufficient resources to ensure compliance? In addition, a strong compliance system will also ensure that staff have the ability to identify and prevent appraisal discrimination. In addition, a strong compliance system has processes in place to respond timely and satisfactorily to changes in applicable law, guidance, products, services, and market conditions. As we all know, that the lending and appraisal industries recently have seen changes brought about by artificial intelligence and automated standards in underwriting and appraisal. A strong compliance system will include the ability to evaluate these types of product changes for any risk factors before implementing them. Finally, a strong compliance system has mechanisms to identify compliance risks, including new or emerging risks in products and services. For example, there have been many news stories and some cases that you've heard about today regarding appraisal discrimination. A strong compliance system will include mechanisms for management to stay informed about these cases and to pass on the lessons about discrimination risks and that those stories and cases teach. So even if you are in a one-person or two-person shop, keeping up to date on the types of complaints, fair lending complaints, or guidance from the GSEs on appraisal is good to ensure that you are keeping abreast of things that are happening in the field. Next slide, please. Now I'm going to talk about some of the best practices that can help appraisers and lenders avoid violating the fair housing laws. First, a strong compliance system has policies and procedures that ensure that inappropriate words and phrases are not included in appraisal reports. That's something that Morgan talked about earlier, and was reinforced by some of the cases that we've already reviewed. These policies and procedures should also include ways to ensure consistent treatment of similar homes and neighborhoods without reference to race, national origin, religion, familial status, disability, or sex. Scott talked about that during his presentation. He also talked about the FHFA conducting an analysis of millions of appraisal reports that found thousands of appraisals contain inappropriate references to protected class characteristics and appraisal reports which explicitly linked race and risk. A strong compliance system would have prevented the use of inappropriate words and phrases and would have ensured consistent treatment of neighborhoods and homes. Next slide, please. A strong compliance system also includes fair housing training. Some states are already requiring appraisers to take fair housing training when renewing their licenses. In states where this is not required, fair housing training could include comprehensive and accurate training developed and approved by fair housing experts. A strong compliance system has ways to update the training to address changes in applicable law, guidance from state and federal regulators, and changes in products, services, and markets. In 2016, the FFIEC, on behalf of its members, issued the Uniform Interagency Consumer Compliance Rating System, also known as Consumer Compliance Rating Guidance. Consumer compliance ratings are critically important to financial institutions as they affect various aspects of a lender's business, including the ability to expand. Moreover, fair lending violations can impact the consumer compliance rating. So although the guidance is designed for examiners reviewing the compliance system of a regulated financial institution, you can improve your business and your relationship with your lender clients and consumers by understanding the FFIEC guidance that was issued in 2016. Next slide, please. Some real estate related allegations of discrimination are based on an appraiser's interaction with the consumer. I think all of my colleagues talked about consumer interaction prior to me. But a strong compliance management system includes processes and procedures for addressing consumer complaints and relating to consumer interactions is fundamental in ensuring that your compliance system is strong. For example, as Siobhan has already talked about, when a consumer requests a reconsideration of value, an appraiser should respond in a fair and appropriate manner, even though many times an appraiser could feel attacked or believe that their methodology has been misunderstood. In 2023, Fannie Mae, the federal financial regulators, and HUD provided guidance regarding the reconsideration of value. The regulators' guidance included a recommendation that some ROV-related procedures, including an ROV as a possible resolution for consumer complaints, rather than a start of a protracted disagreement with the consumer. In other words, don't look at an ROV as an attack, but rather as an opportunity to explain your reasoning and the choices you made during your appraisal. In addition, it is in the best interest of your business, the lender client, and the consumer to carefully evaluate the request for an ROV. For that reason, it's important to take the time to review the appraisal report for errors and thoughtfully consider any new information. This should be included in all of your processes and procedures and is also important to a strong CMS. Finally, it's important to document your reasoning for revising or maintaining the opinion of value. It is helpful to use plain language, as Siobhan has already said, so that anyone reviewing the appraisal report can easily understand how the valuation was developed and why certain information was or was not included. Such careful documentation can be tedious, but as part of a strong compliance management system, it may save time for you and your lender client in the long run. Next slide, please. A final technique which can be used in creating a compliance system to minimize the risk of discretion which leads to discrimination is periodic audits of appraisal reports. A compliance system that includes auditing and monitoring of an appraiser's work can help minimize the risk of fair housing violations. For example, a lender could design an audit to pull a random sample of appraisal reports to ensure consistency across consumers and communities in the descriptions of the subject property, as well as for selection of comparable values, value adjustments, and reconciliation. If monitoring by a lender as part of their CMS reveals potential discrimination, a strong compliance system will provide for changes in policies to minimize risk. A compliance system that includes tiered consequences for staff or third-party vendors, including training, suspension, or termination, demonstrates that the lender or appraiser is committed to preventing and correcting discrimination. Finally, when creating a compliance system, consider including remediation recommendations for harmed consumers. We recognize that many appraisal firms have few people on staff. Even if you cannot implement all of the guidance recommended with regards to a compliance system, it's still important to recognize the types of policies and procedures a lender may implement in its own compliance system that may have an impact on you as an appraiser. And now I'll turn it over to Maureen.
Thanks, Erin. Next slide, please. Next slide, please. Now we will turn to the last risk factor, the statistical analysis. Unexplained statistical disparities have long been viewed as indicators of the risk of discrimination. Since the 1990s, federal agencies and private plaintiffs have used statistical analysis to provide evidence of fair lending discrimination. For example, in the 1992 case of Steptoe v. Savings of America, the court found that the plaintiffs had established an initial case of appraisal discrimination, in part because the statistical analysis suggested different treatment in the racially mixed Old West End of Toledo, Ohio, versus the majority white suburbs. Now, this may be confusing because there are always some adverse outcomes in real estate transactions, such as denials, higher pricing, and valuations below the contract price. But there can be a problem when there are unexplained differences in the frequency or amount of the adverse outcomes on a prohibited basis, such as race. Let's look at an example. Next slide, please. So here's an example of fair lending discrimination and pricing. The DOJ's 2011 case against Countrywide, a large mortgage lender. This case is notable for a number of reasons. First, in the complaint, the DOJ noted some of the risk factors we've discussed. The DOJ noted that the lender provided mortgage brokers with broad discretion to set the interest rates and fees. That pricing was not based on credit risk. Also, the DOJ noted that the lender had a weak compliance management system. That is, the lender knew or had reason to know, based on its own monitoring, that its policies of providing mortgage brokers with broad discretion was resulting in discrimination. Yet the lender did not change its policies or compensate the harmed borrowers. Second, this complaint alleged that the lender was responsible for the actions of the third-party mortgage brokers. That is, similar to appraisers, the mortgage brokers were independent third parties, but the lender was held liable for their actions. With respect to the statistical analysis, the DOJ was able to show that the lender allowed the mortgage brokers to charge higher interest rates and fees to Black and Latino borrowers. These disparities, or differences, were not related to credit risk and were not explained. Also, the disparities were statistically significant. which means that the results could not have occurred by chance. Finally, the disparities were practically significant, which means that they had a practical, real-world significance, not just a statistical one. For example, the average Black borrower in Chicago borrowing $200,000 would pay $1,235 more than a similar white borrower. The average Latino borrower would pay $1,100 more. Again, these differences were not explained by credit risk. In the end, the lender was held liable for the actions of its employee and third-party mortgage brokers, resulting in a court-approved settlement of over $335 million. Now let's see how this type of statistical analysis may be applied in the context of potential appraisal discrimination. Next slide, please. Let's explore a hypothetical based on Freddie Mac's research showing that the appraised value is more likely to come in below the contract price in communities of color. Note that the statistical analysis could be done at the GSE, lender, AMC, or appraiser level, but let's assume that the analysis is done at the lender level. Let's also assume that the lender provides the appraisers with broad discretion and has a weak compliance management system. For example, let's assume the lender knows or should know that several of the independent third-party appraisers have been the subject of complaints and requests for reconsideration of value on the basis of race. But the lender has done nothing to impose consequences on the appraisers or compensate the harmed consumers. Next, let's assume that a government agency conducts a statistical analysis showing that the lender's pool of appraisal reports shows an unexplained disparity in the percentage of times that the appraised value fell below the contract price in majority Black or majority Latino census tracts when compared to majority white census tracts. Let's say that the disparity exists at both the national level and for several large metropolitan statistical areas. Finally, let's assume that the disparity is not explained, the disparity is statistically significant, and the disparity is practically significant because most of the borrowers of color were not able to purchase the intended homes and the undervaluation decreased the value of communities of color. So this is an example of how the statistical analysis could show the risk of appraisal discrimination. Next slide, please. Next, let's explore a hypothetical based on FHFA's research showing that appraisers were less likely to use time adjustments in communities of color. Time adjustments mean that in a rising market, an appraiser should adjust the value of the comp to account for the rise in prices over the time period since the comp sale closed. For example, if prices rose by 5% since the date of closing, the appraiser should adjust the comp sale price by an increase of 5%. Note that the statistical analysis could be done at the GSE, lender, AMC, or appraiser level, but let's assume that the analysis is done at the lender level. Let's also assume that the lender provides the appraisers with broad discretion to use time adjustments and has a weak compliance management system. For example, let's assume the lender knows or has reason to know based on its own monitoring that its policies of providing appraisers with broad discretion was resulting in appraisers failing to use time adjustments in communities of color. But the lender has done nothing to impose consequences on the appraisers or compensate the harmed consumers. Next, let's assume that a government agency conducts a statistical analysis showing that the lender's pool of appraisal reports shows an unexplained disparity in the percentage of times the third-party appraisers use time adjustments in majority Black or majority Latino census tracts when compared to majority white census tracts. Let's say the disparity exists at both the national level and for several large metropolitan statistical areas. Finally, we can assume that the disparity is not explained, the disparity is statistically significant, and the disparity is practically significant because in communities of color, the time adjustments were used less and were less likely to result in the appraised value reaching the contract price. As FHFA noted, time adjustments could make the difference between an appraisal that allows a home purchase to move forward and one that does not. So this would be another example of how the statistical analysis could show the risk of appraisal discrimination. Next slide, please. Finally, let's explore a hypothetical based on Fannie Mae's research showing that when compared to the AVM value, white-owned homes in majority Black neighborhoods were more likely to be overvalued. Note that the statistical analysis could be done at the GSE, lender, AMC, or appraiser level. But let's assume that the analysis is done at the lender level. Let's also assume that the lender provides the appraisers with broad discretion to select comps and has a weak compliance management system. For example, let's assume the lender knows or should know that several of the independent third-party appraisers have been the subject of complaints and requests for reconsideration of value on the basis of race based on comp selection. But the lender has done nothing to impose consequences on the appraisers or compensate the harmed consumers. Next, let's assume that a government agency conducts a statistical analysis showing that the lender's pool of appraisal reports shows an unexplained disparity in the percentage of times the appraised value exceeds the AVM value for white-owned homes in majority Black census tracts when compared to Black-owned homes in the same census tracts. Let's say the disparity exists at both the national level and for several large metropolitan statistical areas. Next, let's assume that the government agency's analysis shows that the disparity is mainly occurring because for the white-owned homes, the appraisers relied on comparable sales from outside of the subject property's immediate area, that is, in the majority Black community, even though potentially more appropriate comps were available closer to the subject property. Finally, we can assume that the disparity is not explained by an acceptable explanation. The disparity is statistically significant, and the disparity is practically significant because Black homeowners are receiving lesser values that deplete equity and borrowing power. So this is our last example of how the statistical analysis could show the risk of appraisal discrimination. Next slide, please. To manage the risk of discrimination related to statistical analysis, the appraiser can follow the best practices described in the prior slides, including conducting error reviews for accuracy, developing checklists to minimize discretion, documenting decisions, especially decisions that depart from industry standards, and conducting audits and monitoring outcomes. Next slide, please. So to recap, based on our analysis of the cases and research, we offer the following as risk factors indicating potential appraisal discrimination: higher valuations, the appraisal report, business processes, compliance management systems, and statistical analysis. Similarly, based on our analysis of best practices and compliance management systems, we recommend the following risk management techniques: board, senior management, and leadership oversight, including third-party oversight, policies and procedures, including lists of unacceptable or problematic words or phrases, public source reviews, and procedures to increase consistent outcomes, including error reviews, checklists, and documentation. We also recommend fair housing training developed by fair housing experts, complaint and ROV processes and tracking, and audits and monitoring. Next slide, please. This is the conclusion of our briefing. We hope this week to post the slides and a link to the video recording on NAFA's website under the section on our work on appraisal bias. So with that, we thank you for your time, attention, and dedication to fair housing for all. Thank you.